it's more important for an asset class to be underinvested than undervalued, because underinvested means that it can be more invested. That was the issue with the Mac 7. Maybe they were not overvalued, but they were overinvested.
Yes.
It was overcrowded. This is why they're going through kind of, say, painful phase. But with cryptos, it's still very low adoption, very low inclusion in multi-asset portfolios. Think of pension funds, treasury portfolios of companies, private banks. There is so much to come. I fully understand that people, for the time being, many of them still don't appreciate, but it will come. And just, the good thing with human being is that they can change their minds. Remember, Larry Fink, 2017, he said Bitcoin is an index of money laundering. Fast forward to 2024, and he got probably the most successful launch of an ETF in history with the iShares Bitcoin ETF. So, human beings can change their minds.
Today, we take a step into the arena of global finance with Charles-Henri Monchau, the visionary Chief Investment Officer of Banque, sister company of Seize Capital. With a career spanning 2 decades, Monchau kicked off his journey on the trading desk at BNP Paribas, later sharpening his expertise at Lombard-Odier, Rothschild, Deutsche Bank, Almar Capital, Flowbank, and then Banque. A global thinker, his Swiss-French background, born in Greece and raised in Africa, brings a fresh, multifaceted lens to the complexities of today's economy. His international experience across diverse markets has fine-tuned his ability to spot opportunities and navigate risks in an increasingly connected financial world. Known for his forward-looking strategies, Charles blends classic investment principles with innovative approaches to tackle today's markets. In this episode, we explore his distinctive taste on modern investing, the shifts and challenges on the horizon, and the impact of social media. Great, Charles, thanks for being here.
Thank you.
We finally managed to do this. This has been months in the making. Good. Well, you came out from Geneva this morning, so really appreciate that. But look, you're very well known in Switzerland. In fact, every time, since I moved to Switzerland a couple of years ago, every time I sit down in a client's office, they're like, oh, Seize. Yeah, I know Charles-Henri from LinkedIn. So you're famous here in Switzerland. But I think most people probably don't know so much about your journey. They obviously just see your posts on LinkedIn. So maybe you could just give us a bit of your background, how you came here and how you ended up being the CIO of Seize Bank.
So I'm both Swiss and French. No one is perfect. I was born in Greece and grew up in Africa. And so I finished my study in Switzerland. And I got an internship. At the time it was BNP Switzerland. And the internship was with a CIO. And I finally found out what I wanted to do. Why is that? Because I found fascinating in terms of multitasking. Because that's a role where, you need to obviously analyze macro perspective, the markets. You need to manage money, you need to manage people, you need to face clients, you need to be up to speed. Not a single day is the same. Today is the Liberation Day in the US, obviously it's a very different day than the other days. And also, you need to have the big picture. You need to connect the dots, understand the macro landscape, geopolitics, markets, how everything is intertwined. So I found my, let's say, where I wanted to go. So once you have your goal, you need to obviously make sure that you reach this goal. And I kind of created my own toolbox to become indeed a CIO. So I wanted to be up to speed on most asset classes, to also understand obviously the economy, how equity markets work, how fixed income market works, how hedge fund work. And this is something I've been building over the years. So I finally became CIO, first with EFG, then Deutsche. I moved to Dubai. And then today, I'm CIO at Banque.
That's nice. Very nice. How do you, you are posting on LinkedIn once an hour, every hour. You're staying on top of markets. You're on top of every aspect of it. that is in itself a full-time job. But I know, having tried to organize this podcast, like getting you pinned down for a meeting where you're not traveling here, there, and everywhere. How do you manage it all?
So my full-time job is to take care of our clients' money, to represent the bank. So that's my full-time job, and the posting on social media is part of my routine. I obviously don't post every hour. This can be programmed. So usually I do it early in the morning, sometimes midday, and then in the evening. And the reason I'm doing this is the following: is that, as mentioned before, things are, you need to have the big picture, but also things are moving so fast. So you need to be almost 24/7 on, to follow what is happening, because nowadays a lot of things are also happening over the weekends. So you need to stay apace with the news flow. And I think that the best way to understand something in details is to be able to explain it in simple way. That's the most difficult thing. If you really understand something, you should be able to even explain it to your kids. Because here the goal is really to explain it in a simple way, a few sentences, a chart, and then share it.
Yeah.
And then by sharing it, okay, there are obviously some advantages, because that also enable some branding with the banks, the media, clients, stakeholders. They think about us when they read the news on Bank C's or C's Group or C's Capital. But then they also interact. They can, give some feedbacks, highlight some points, share it with the network. So there are a lot of advantages of doing so. So again, I'm not a full-time influencer. I'm first and foremost a CIO. But by using social media, I can not only have some discipline with myself. It's a routine. I just want to make sure that I'm keep, let's say, the flow going and then share it. But also there is this habit of explaining things in a simple way, which makes me stronger, which makes the team stronger. And obviously it also helps us to share, insights of Banksys.
A lot of people that watch this podcast don't really understand necessarily what a private bank is. And you said that, the private bank is in the business of staying rich as opposed to get rich.
Yep.
But I think one of the interesting things about C's Group is that it is an extremely innovative group. Eric obviously was one of the first people to bring hedge funds to Switzerland. Now you're full blown into crypto. C's Capital has products, denominated in Bitcoin. Like it's a group that is definitely sort of pushing the boundaries, and where other financial institutions are being very conservative. So how do you sort of balance that stay rich versus get rich with the way that you particularly are a big part of pushing the boundaries of C's Bank?
Yeah. But there are different things. Indeed, the stay rich instead of becoming rich is part of the private banking DNA. The compounding effect is something very important, because nowadays you also need to not just, let's say, keep your savings safe, but also protect against inflation, also have your assets in a safe place. We have seen in the recent past some financial players just blowing up. So you need to also have your money, your assets in a safe place. And Banksys is one of the banks in Switzerland with the highest tier 1 ratio. So that makes it already very strong, a very appealing value proposal for private clients. Now, regarding Banksys and C's Group, I think it's a very unique place. I don't think that there are many. It's unique in the sense that, first, it's a family business with a unique human dimension. We are very close, though all of the employees are very close to the family. We can discuss with Eric C's at the cafeteria or with Nicolas and Mark. They are very down to earth, very accessible. So I think it's very unique in the private banking world. That's point number one. Two, innovation. You mentioned it. This group has always been innovative. And it started with the founder. Eric was one of the banker in Switzerland who brought hedge funds into portfolios, and then private equity. And then they had this bold move of including digital assets in the private bank offering and in C's Capital offering. So always very innovative. And it's not just the founder and the family. It's really all of us. Innovation is part of the DNA. And the third aspect, which is, I think, at least as important, is entrepreneurship. We all feel entrepreneur. Maybe we love to be on our own, but sometimes there are also some difficulty with this. It's a very tough word.
Yeah.
But here there's the best of two worlds because we are part of a company, but we feel every day being entrepreneur. We can feel that we can move the needle.
I'd agree with that for sure. Let's just go back to that digital asset point. I think obviously, if we look back to the 90s when Seize Bank was first started, I'm sure Eric got a lot of pushback from people about hedge funds. You're out there, you're meeting clients every day, you're talking about crypto and hopefully more predominantly Bitcoin. Then, how much pushback are you getting from people still? I mean, like, we are still so early.
Yeah.
Like, I imagine you go into client meetings and you can get some pretty frosty pushback. How does that go? How much is that happening? Is it still quite a lot as opposed to how it was 5 years ago? Yeah, how's that evolved?
So you mentioned, I think, two unique selling proposals of Seize Capital, which are hedge funds and digital assets. Hedge funds, it has been a long story. In the 90s, or even to, let's say, early 2000s, it was very tough to get hedge funds going into clients' portfolios. And then it skyrocketed. At some point, some banks had like a 30% allocation to hedge funds. Then Lehman Brothers came, and it was again a nasty word, and no one wanted hedge funds. It's coming back with a vengeance, by the way, because now there is this high correlation between equities and bonds, and hedge funds are coming back, which is great. And then digital assets. Here, the pushback is coming from different, let's say, perspectives. The first one is regulatory, because regulation, we are lucky in Switzerland, is quite open, but there are still some, let's say, constraints, especially for discretionary mandates, but also to some extent advisory. Two is the fact that there is high volatility and high downside risk, and we're talking about the business of staying rich instead of becoming rich. So obviously, if you want to stay rich, you want to avoid drawdowns. So that kind of creates some fears with some clients. And the third one is lack of education or ignorance. And these are three big headwinds. But we found a way, and in part thanks to you. Discretionary mandates, we have been allocating to Seize Crest, which is your funds of crypto hedge funds, because here it ticks all of the boxes. One, which is regulatory one. It's a fund of fund format. So that, makes it possible to include it into discretionary accounts. Point number two, because it's mainly arbitrage strategies and uncorrelated to cryptos, very low drawdowns, very low volatility. And then three, we don't need to have clients embracing cryptos because we can explain to them that it's mainly about extracting inefficiencies. And they, abide to this. And so far, it has been great. Again, thanks to you, because performance has been fantastic. Very low volatility, no correlation, and at least that enables us to start with some digital asset exposure for clients into portfolios. The next step is maybe Delta One with BTC, because that's something that we offer, directly to clients at the banks level or through the ETF. But at least it's a first step. But there is still a lot to go, as you know, in terms of education and having, clients and people understanding what crypto, especially Bitcoin, is about.
But yeah, my question more is though, have you got any sort of violent reactions from clients when you go in and they're like, I see you posting about Bitcoin all the time, get out of my office. Like, are you having these kind of reactions, or people feel like they're opening up more? I mean, certainly 8 years ago, people were like, you're crazy, right? When we I first started talking about it to people. But how because you're in front of private bank clients practically every day. What's the feeling right now?
Well, look, some private clients say, look, guys, even though you aim to have these fund of crypto hedge funds in the portfolios, I just have it as a constraint. I don't want any crypto exposure. I respect that. We are here also to match our client preferences. If they don't want to, that's okay. Obviously we have a conversation with them to try to explain why, they should consider it. But if they don't want it, we don't include it. Now, I think that what happened last year with this adoption coming from big asset managers in the US and the launch of the ETF by BlackRock, Fidelity, and the likes, changed a lot in terms of perceptions. So there is, I think, understanding that it's becoming more institutional, and there is also the acceptance from the White House, first time ever that there is a pro-crypto US administration. That being said, because you were mentioning LinkedIn, and I think that's the beauty also of social network, is free speech. So I'm lucky enough to have freedom to share my views as a CIO on social media, and this is accepted by the bank. So that's great. That's point number one. Point number two, free speech means that there is freedom for those who read, to follow, to react. And the reaction sometimes can be indeed very violent, which is part of the controversy about Bitcoin. Look, if they are insulting, I will not obviously answer to them, but if they are somewhat constructive, even negative, but that's great. First, because it enables a discussion, and it's great to have conversation about it, because this is how you can also educate people. Two, I can still, learn something. That's great. And point number three, what I like with this is that, there is this old adage saying that markets needs to climb a wall of worries. The higher the wall, the higher the potential of returns. And I think that as long as we have so much pushback on Bitcoin, that's actually a good sign. I like to be contrarian. And the fact that there are still so much pushback on BTC, on Bitcoin, is a sign that there is still ways to go, because it's still not well adopted. It's just 0.2% of global assets. To become 1%, it needs to grow by 5 times. That's a great news. And we still don't see BTC being part of model portfolios in most places. It has started in the US with Fidelity and BlackRock, for instance, but it's still very far from being part of global multi-assets portfolios. So I think that's the good thing, is that because it's more important for an asset class to be underinvested than undervalued, because underinvested means that it can be more invested. That was the issue with the Mac 7. Maybe they were not overvalued, but they were overinvested. It was overcrowded. This is why they're going through kind of, say, painful phase. But with cryptos, it's still very low adoption, very low inclusion in multi-asset portfolios. Think about pension funds, treasury portfolios of companies, private banks. There is so much to come.
Yeah, I'm always torn when I look at your posts on LinkedIn, because, as I said, I messaged you the other day. I was like, how are you dealing with these commentators? Because it's just they'll say ridiculous things, and it's, they'll say Bitcoin's a Ponzi, and then I'll ask them, okay, can you just walk me through how you see the difficulty adjustment being, good or bad? One guy says, I don't know what you're talking about. The other guy says, well, it's a terrible idea because it makes the cost of mining Bitcoin go up if the price goes up, which obviously is not accurate at all. So a lot of these commentators are completely ignorant about it, but extremely over arrogant and over opinionated, given their lack of knowledge of the subject. So I always find myself having to step in and make a comment.
Thank you for this. Yeah.
But how do you? I mean, like you say, you ignore the ones who are rude, but like to that point, obviously, I just get to a point where I'm like, I have to respond and say something, because you have so many followers that if these people aren't corrected, and I do feel that they, to some degree, are just commenting on your post because you have so many followers, so that they're getting their audience picked up. And if someone equally hasn't researched Bitcoin, they'll go, okay, well, that guy's a financial advisor and he hates Bitcoin, so I should, give him my business. So maybe it's a marketing thing, but how do you deal with all of that?
It's possible, and I need to keep this in mind. And also, I also try to avoid being seen as just a Bitcoin advocate. One time someone told me you should have a lot, or you should be overexposed in your firm to push it as much. I'm not pushing it. I'm just sharing the news flow as I'm doing in other asset classes. And yes, I think it's a very interesting asset. It's also comes into this store value story. We live in an exceptional time. We live in the fiat system. Since the 70s. This is something that most people don't realize, that especially, into fiat currency like the dollar, there is this loss of purchasing power, money debasements, which forces you to be either invested into risk assets or in store values like gold and also Bitcoin.
Yeah.
So they need to face this reality. And Bitcoin didn't come by coincidence. First is the technological breakthrough. And this is why last year we crossed the 1 billion transactions without a single glitch happening. It always worked without a CEO, without a headquarter, without a CTO. It worked perfectly. So one is technological breakthrough, which is amazing. And two, yeah, it's a way to protect against these money debasements.
Yeah.
And maybe we'll see more coming. So I think it's very interesting. I fully understand that people, for the time being, many of them still don't appreciate, but it will come. And just the good thing with human being is that they can change their minds. Remember,
Yeah.
Larry Fink, 2017, he said Bitcoin is an index of money laundering. Fast forward to 2024, and he got probably the most successful launch of an ETF in history with the iShares Bitcoin ETF. So, human beings can change their minds.
Yeah.
And here, again, we are not here to have everyone embracing our view. We are just here to share some views. They might be right, they might be wrong, but at least it's good to have constructive discussion. And as long as they are, these comments are not there for, as you mentioned, personal interest of being seen on the network or just blaming us, I think it's okay to have discussion. It's quite good actually.
Yeah, no, I definitely agree. It helps everybody just improve and learn, right? It opens the discussion to that. No, to your point about paper money and fiat currency, I mean, I was saying to someone yesterday, we are going to look back on this time and say, how did that even happen?
Yeah.
Like, how did people work their whole lives for bits of paper that someone could print?
Yeah.
Like, it's funny. Larry Fink made a comment a couple of days ago, right, about how if the US doesn't get its debt under control, then other forms of money are going to benefit, like Bitcoin specifically.
Exactly.
Okay, so looking forward to sort of other impacts on market, obviously Trump has, been fairly heavy-handed on Europe, particularly I think Vance made a very interesting speech at the Munich conference recently. Trump has, or at least his administration has, said that tariffs are going to be heavy on the UK unless they sort out free speech, which is a very interesting angle to be taken with Europe. He's almost forcing change in Europe. We talked about it earlier about Zelensky and that whole conversation being sort of the turning point to that. Like, how do you see things going from here? Obviously, we've just had announcements of the tariffs.
Yeah.
How are things going to go, particularly with Europe? Because Europe is this over-regulated state. It somehow is just living on this, debt mountain, overprinting money with zero innovation, just regulation.
Yeah.
Where's it all going to go?
Yeah, it's probably the gap has been widening between US and Europe for years now, and actually the widening of the gap accelerated under Biden.
Yeah.
And now that we have Trump 2.0, it's kind of a wake-up call for Europe. I think the world has already changed years ago after COVID and the Russia-Ukraine situation. We are now in a world where there is globalization, reshoring, national capitalism. Obviously, this is inflationary, but it also means nominal growth and high innovation. So there are pros and cons, but obviously, all of the regions and countries, they need to make sure that they're equipped to deal with this new paradigm. So we wrote 2 pieces recently. One is about national capitalism. We believe that indeed it's very important for most region and country to build their own sovereignty and make sure that they also have their own business and that they are safe within their borders. One example is defense. So finally, Europe has accepted to spend on defense, and they have this Rearm Europe plan, which is massive. But they will probably make sure that also they have their own, they manufacture their own weapons. This is what about national capitalism and sovereignty is about, is making sure that you're taking care of yourself. I think this is what is going to happen with Europe. Not everything is solved because the productivity gap between Europe and US is still there. I don't see anything yet to close the gap, to be honest. There are also the dimension of energy. The energy cost in Europe is still twice the cost of energy in the US. Energy is very important. The economy at the end is you take input, use energy, and you create an output. So if your energy cost is twice, the cost of your competitor, you are in trouble. So they still need to solve these out. But again, I think it's a very important moment for Europe. They seems to wake up. And the second piece we wrote is about these Mar-a-Lago Accords, which could take place this summer. This year is the 40 years anniversary of the Plaza Accord, which was about the dollar devaluation. And here can come to deal with the US. Is about the US will tell the world, you guys make sure that the dollar is weaker, so you revalue your currency. Two, we want manufacturing to take place in the US. And three, we want to swap part of our debts into century bonds. So how is the rest of the world going to react to this? What are the Chinese going to say? What is Europe going to say? So it's going to be very, very important moments. So I think this year, again, is going to be very interesting. It's going to be very volatile. Macro volatility leads to market volatility. And Europe needs to find its way.
Yeah, I mean, obviously Europe's got itself embroiled in this sort of ESG agenda as well. And I think this is how Germany made these ridiculous decisions to shut all their nuclear power stations, and now they're at the whim of basically Russian natural gas, which was highlighted. I mean, this was highlighted decades ago that this was a potential problem for Europe, and they literally walked straight into the hole.
Yeah.
And you look at it and you're like, how did this happen? And I think ESG was a big component of this. Like the Green Party was responsible for shutting down. They've shut down coal power stations. You're exactly right. Energy is the input for an economy. Like if you don't have abundant energy, you are going to struggle as a society to continue to grow. So, trying to, let's talk about both those things. First of all, where's the ray of light right here, right now for Europe? And, how do you see things changing with the ESG agenda? I think, $13 billion of outflows in ESG investments in the US. Seems like the US is moving now in the other direction with Trump. But Europe, at least for the moment, feels very entrenched in this ESG agenda. So how do you see all that going?
Well, yeah, there are various topics. So first, the intent of Europe was a great intent. It's just global warming. So we know we need to do something about it. And this is one area where indeed Europe has been leading. They have been leading in terms of decarbonization, about CO2 reduction. They also brought some leadership, probably putting some pressure in US also to make some move on that, to Asia, and also in some emerging markets. I travel very often to the Middle East. You look at countries like Saudi or UAE, they have some targets to go, zero emissions by 2040 and 2050. So definitely Europe has a clear lead on that. Now, what they inflicted to themselves was quite tough. And probably, they wanted to go faster than the music, or at least faster than other countries. And this was indeed costly. So now they need to come with what we called, let's say, like ESG pragmatism. So they need to keep the intent alive because it's a great intent, but they need to have the right means to do so. And you mentioned nuclear. That's one of our investment theme, because nuclear is one way to optimize the grid, but in a let's say in an efficient way. And nuclear investments through uranium is going to be a key theme in the years and decades to come. Probably the German will change their mind. They change their mind on the fiscal side, so they might change their mind on the nuclear side as well. But yeah, you can feel that there is indeed some changes on that side. They will probably keep the focus, which again is great. In terms of flows, the outflows has been mainly happening in the US. In Europe, from a client perspective, we still see some decent interest for ESG investing. I think it's still very high in the agenda. If you look at also the way mutual funds, for instance, are labeled, it remains key. But it needs to be more pragmatic because it's a competition at the end. And they need to revive growth. And that means indeed, use of energy.
Yeah, I often look at that and think those mutual funds that are super focused on the ESG and ticking all the boxes, First of all, I'm not necessarily sure that I always agree with all the boxes, but I definitely agree with you that we need to be trying to do something to improve the environmental component for our kids. But like, if you think about that, is it private bank clients or is it institutions like pensions that are managing other people's money that are like, okay, yeah, that's the box we want to see ticked, and they're not necessarily being held to account in the same way that a hedge fund manager is, obviously extremely focused on performance.
Yeah.
Is that where the differentiation is? And certainly, I'm surprised to hear you say that you're seeing a focus on ESG. Are you seeing that from the clients of the private bank?
Yeah, especially the young generation. I think the young generation, they are very much focused on this. That's a key priority for them, and they still ask for it, which is good. The institutional players, I think, have been following this ESG focus, very closely. The private clients, it's more like it's a mindset now, and again, it looks like it's entrenched, to them at this stage. On our side, I think there is a way to match what you mentioned about performance and ESG, is the later, which is very often forgotten, the G of the ESG governance.
Yep.
Because usually when you have companies with strong governance, they are good on financial performance, because good governance leads to strong financial performance. And usually the E and the S follows as well.
This brings us on nicely to the section where we talk a little bit more about what you're recommending to people now in terms of trade ideas. You mentioned uranium as obviously the nuclear play. But what else do you think of being the focus areas for you as the CIO and the bank in terms of where you're directing clients to be allocating capital right now?
Yeah. Well, I will start with a very high level, which is the following, is that first, you need to stay invested. As mentioned before, we live in this fiat system, maybe with the exception of Swiss franc, which is case apart. The other fiat currencies, it's money debasement.
Yeah.
So you need to protect your purchasing power. That means that you need to have allocation to risk assets. So equities, liquid real estates, hedge funds, credit, high yield bonds, and not sit in cash. That's the first advice. The second advice is one which is related to stay invested, is the compounding interest. A compounded average is one of the most powerful force in finance. So don't try to time the market and say, oh my God, and say, well, the headlines are ugly, so I'm going to, move back to cash and come back later. You need to be invested and makes your portfolio work for you with some adjustment depending on the, let's say, the news flow and what is happening on the macro side, but you need to stay invested. That's the first thing. Two, we live in a world where, because inflation is now higher than before, the correlation between equities and bonds has moved to positive. This has some implication in terms of portfolio construction. So that means that in terms of diversification, you need to find other diversifiers than the government bonds. And alternatives is one of them. I think that's at the core of Seas Capital.
Yeah.
Uncorrelated alpha. We are all looking for uncorrelated alpha. So we have been increasing the allocation to alternatives with the liquid hedge funds. But also there is a demand more and more by clients to move into what is called this endowment approach. For those clients who can, accept it, they increase the allocation to illiquids. Illiquids means lower correlation and higher return. So that really improves the Sharpe ratio of your overall portfolio. So I think that's key to look at these dimensions is, again, staying invested and to portfolio construction. And then there are always some interesting themes. One of them this year is definitely the broadening of the equity markets. It has been a lot about US tech over the last 2 years. And now we can see US tech is under pressure.
What did you say? The browning?
The broadening, yeah. So broadening in the sense that the market advance, equity market advance before was very narrow, led by these Mag 7 or Mag 8.
Yeah.
And now we can see that it's broadening to other markets, other sectors. Europe is the best performer with China year to date. US is the worst. So it's very important to stay diversified and to find, let's say, new sources of alpha and returns, even within equities. So it's a lot about, let's say, diversification, quality, and being open to alternatives once possible.
Yeah, look, I completely agree with you, obviously, working at a shop focused on alternatives. How much of the discretionary portfolio that you have at the bank is in alternatives as a percentage?
Between 10 and 15%.
That's
So that's for
low.
the let's say the normal the usual format. But we are working on new format which are increasing the allocation to illiquids, to alternatives.
Yeah, I mean, it's quite low. I mean, compared to the majority of family structures we speak to, like, minimum sort of 20% alternatives. So is that in line with other private banks? Are you higher or lower? Or?
No, it's even higher than many private banks. Wow. But I think there is a new trend, which again is coming from the new landscape we're currently in. And so we are adapting this. We're trying to also be on the forefront of it.
Yeah.
And this is why we're working on new type of discretionary mandates, DPM plus, which includes more alternatives, and also this endowment approach, which is mainly about having as much illiquids as liquids.
Last question for you.
Yeah.
How are you, Charles-Henri, allocating your own portfolio? What does it look like? What are the key components?
Yeah, so it's going to be a bit different. That's also due. I think what is key when you look at your own assets is to be first look at your reference currency and two, your risk appetite. You need to understand yourself very well.
Yeah,
and that's not easy. Huh? It's sometimes you think you know yourself, but you don't know in front of what can happen in the market and so on. So first, my reference currency is Swiss franc, which is the most difficult reference currency in the world because that's the strongest currency in the world.
Yeah.
And two, my risk appetite is that I'm able to withstand high volatility as long as I'm sure I don't need the money now. So this is why I created what is called a barbell approach. So the two sides of the barbell are the following. There is one side of the barbell which is safe, very safe. It's basically my house and cash for the family. In case anything bad happen, we have cash. And this is not an issue in Switzerland to have cash because we have very low inflation. So there is no loss of purchasing power. And at least I can sleep very well at night. I have my house, I have my cash just in case of troubles. And then the other side of the barbell is made of investments. I have strong belief, strong convictions on them, but I know that they can be illiquids or they can be super volatile. So here I'm investing money that I will be very happy to have in the future, if possible, multiplied, but I don't need now. So here you can think about US tech, BTC, and some illiquids. So that's, let's say, another way to build portfolios. Again, that I sleep very well at night because I'm not under stress, which means that even if the risky part of the portfolio isn't the pressure, I'm able to live with this volatility because I don't need it now.
Yeah.
And I think that the mix of this barbell so far has been generating very decent returns. And also because I've been avoiding the boring middle. That's all what this barbell approach is about. So it's another way to build portfolio, but again, it's very personal.
Yeah.
Because I have my personal needs and personal way of looking at risk and investments. And so far, so good.
Yeah, it's the Druckenmiller high concentration focus.
Or, the Nassim Taleb approach. Yeah.
Rather than, I heard the expression the other day, diversification.
Yeah, exactly.
It's quite good. Charles, thanks so much for being here.
Yeah.
This was great. Really enjoyed the chat.
Thank you.
We'll do it again.
Thank you so much.